Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets of big business while trying not to get buried under all the financial jargon that is Hallador Energy's September 2025 quarterly report. This report paints a picture of a company navigating a complex energy market, making some significant moves to boost revenue and manage costs. They are seeing a real comeback in their electric operations and a steady performance in coal. We're going to break down what these numbers actually mean for the company, its strategy, and its future. And hey, if you like getting these straightforward breakdowns of corporate filings, make sure you subscribe and join our Discord community linked in the description below. So looking at the balance sheet right now, the 30th of September 2025, we see total assets around $409 million. This is up from about $369 million at the end of last year. This growth is fueled by a healthy rise in current assets like cash and accounts receivable. On the flip side, current liabilities are also up, sitting around $207 million compared to $152 million at the end of last year. Much of this increase is coming from contract liabilities, which signals they are getting paid up front for future energy deliveries. This is a good thing for cash flow. Now here is an interesting point. The company still has a retained deficit, which means overall they have incurred more losses than profits historically. However, this deficit has shrunk significantly from negative $85 million at the end of last year to negative $43 million. This September, this shrinking deficit is a positive sign suggesting they are moving towards profitability. Let's dive straight into the income statement. The 9 months ending the 30th of September 2025 show a net income of about $42 million. This is a huge jump from a net loss of over $10 million in the same period last year. This turnaround is substantial and driven by strong performance in both their electric and coal segments. For the 9 months year to date in 2025, total sales and operating revenues hit around $367 million. Compare that to $310 million for the same period in 2024. That is a solid increase of over $56 million. Digging into the segment's electric sales for the 9 months were almost $239 million. That is a big jump from $192 million last year. This indicates their electric operations are firing on all cylinders. Coal sales also saw an increase, reaching over $119 million for the 9 months compared to $114 million last year. So coal is holding its own and contributing positively. On the electric side, power margin without general and administrative costs was about $67 million for the third quarter of 2025. This is up significantly from just under $24 million in the same quarter last year. This margin improvement is a key indicator of their operational efficiency and pricing power in the electric market. In coal operations, the EBITDA margin for the third quarter was over $8 million. This is a dramatic improvement from a negative margin of almost $3.8 million in the third quarter of 2024. This turnaround in coal operations is very encouraging. Looking at electric sales more closely, delivered energy revenue was $77.7 million for the 3 months ending the 30th of September 2025. This climbed from $56.2 million in the same period last year. The average price per megawatt hour also saw a boost in 2025. Now let's talk costs. Fuel costs for electric operations were about $44.7 million for the third quarter of 2025. This is a notable increase from $30.1 million in the same quarter last year. This rise in fuel costs reflects both higher energy production and an increase in coal prices, which is a direct impact from their coal operations. When it comes to earnings per share, basic earnings per common share, for the 9 months ending the 30th of September 2025 was 98 cents. This is a massive leap from a loss of 27 cents per share in the same period of 2024. This turnaround shows the company is not only generating more revenue, but is also becoming profitable. The company is also heavily involved in stock compensation. As of the end of last year, there were just over 1 million non-vested restricted stock units. During the first 9 months of 2025, they granted over 355,000 more. This indicates a focus on incentivizing their employees through stock ownership, which can align management interests with shareholder interests. Breaking down assets by segment shows electric operations holding assets worth $233 million and coal operations with assets valued at $153 million as of September 2025. The electric side is the larger asset holder, indicating its greater importance to the company's overall value. The management's discussion and analysis highlight some key achievements. They are pleased with their favorable results in the third quarter, generating $146.8 million in revenue with $23.9 million in net income. This represents substantial improvement over the prior year period. The report mentions that favorable summer weather, higher energy demand, and rising natural gas prices created a supportive environment for energy pricing. This directly boosted revenue for their Hallador Power subsidiary. It also notes that after some maintenance, both units at Merom operated very well throughout the quarter. A big part of their strategy appears to be locking in long-term deals for their power generation capacity. They are seeing significant interest from data center developers and energy providers and anticipate making progress on long-term agreements by early 2026. This shows a strategic shift towards more stable and predictable revenue streams. On the coal side, they experienced solid production, increased shipments, and steady operating costs. This helped reduce high inventories and position them well for the upcoming winter season. However, there are some financial tight spots. The company is actively working to refinance their credit agreement and term loan, which are both maturing in 2026. While they believe refinancing is probable, there is no guarantee it will be on favorable terms, potentially impacting their liquidity. Interestingly, their effective tax rate for the first 9 months of 2025 is estimated at around 0%. This is due to specific tax rules and potentially a valuation allowance. For 2024, it was closer to 24%. This difference is worth watching as tax strategies can significantly impact net income. And for a quick note, outside the financials, there is a mention of mine safety disclosures. This is always a crucial aspect for coal companies ensuring they are operating safely and responsibly. So what does all this mean? Hallador Energy is clearly in a turnaround phase. Their electric operations are booming, driven by favorable market conditions and demand for their capacity and energy. Coal operations are showing resilience and improved profitability. They are actively pursuing long-term contracts to secure future revenue, a smart move in the volatile energy market. However, the looming debt maturities are a significant risk factor. Success in refinancing that debt on good terms will be critical for their financial health. The shrinking retained deficit is a strong positive signal showing a path towards profitability. Their focus on transitioning from a coal producer to an integrated power producer is a bold strategy that seems to be paying off in these results. They are leveraging the energy transition rather than fighting it. Overall, Hallador Energy looks like a company on the mend with strong operational performance in key areas. The main challenge ahead is managing their debt obligations and continuing to secure those vital long-term contracts. Their strategic direction seems sound, but execution will be key. Alright, that is our breakdown of Hallador Energy's latest report. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.